Listen to me. If you are about to retire, or you are already sitting in retirement, and you feel like you are being squeezed from both sides, I need you to pause everything and pay close attention right now. You worked 40 years for your freedom. You saved, you sacrificed, and you put your blood, sweat, and tears into building your retirement nest egg. But suddenly, you find yourself stuck squarely in the middle of the sandwich generation. On one side, you have adult children who are struggling with housing costs, student debt, or inflation. On the other side, you have aging parents who need expensive long-term care or help paying their bills. I know what you are feeling. You are feeling torn, you are feeling guilty, and deep down, you are terrified. You are terrified that if you say no to the people you love, they will drown. But if you keep saying yes, you are going to bleed your own retirement accounts dry and end up dependent on someone else later in life. What makes this crisis 10 times worse is that most retirees try to solve these family expenses by blindly pulling cash out of their traditional 401(k)s or IRAs. They think, I need $20,000 to help my son with a house deposit, or I need $15,000 for mom's home care, so I will just withdraw it. Do you have any idea what you are doing when you do that? That is a massive tax trap. Every single dollar you pull out of a traditional retirement account is taxed as ordinary income. When you take out extra lump sums to cover everyone else's financial fires, you pull yourself into a higher tax bracket. You accidentally trigger Medicare premium surcharges, known as IRMAA, which can raise your healthcare costs by hundreds of dollars a month. You turn your tax-free Social Security benefits into taxable income. You are literally paying 40 or 50% in combined taxes and surcharges just to hand cash over to family members. That stops today. Ask yourself this question right now. Are you putting on your own financial oxygen mask first, or are you suffocating your retirement to pay someone else's bills without a tax plan? You can love your family with all your heart, but you must love your own financial security enough to set boundaries and use the tax code intelligently. Here is what you need to do immediately to protect your money and minimize taxes while navigating the sandwich generation. First, if you are providing financial support or paying medical bills for an aging parent, stop writing personal checks to them. Check if they qualify as your dependent for tax purposes under the IRS qualifying relative rules. If you provide more than half of their support and their taxable gross income is below the IRS limit, and remember, non-taxable Social Security income generally does not count against that limit, you may be able to claim them. More importantly, if you pay medical and long-term care expenses directly to the hospital, nursing home, or doctor on behalf of your parent, you can include those expenses on your own itemized tax return. When medical expenses exceed 7.5% of your adjusted gross income, they become deductible. That turns a major family caregiving cost into a powerful tax shield for your income. Second, if you are helping adult children or grandchildren with education or living costs, never hand them cash from your IRA. If you want to pay for college tuition or medical care for a child, pay the institution directly. When you pay tuition directly to a school or medical expenses directly to a provider, those payments are completely exempt from the annual gift tax limits and do not trigger gift tax reporting. Furthermore, if you want to help a child save long-term, consider contributing to a 529 plan or helping them fund a Roth IRA if they have earned income. You are building their future without destroying your current tax bracket. Third, look at your income sources strategically before you pull a dime. If you need cash to support family, withdraw from taxable brokerage accounts where you pay lower capital gains rates, or use tax-free Roth IRA withdrawals first, rather than spiking your ordinary income with traditional IRA distributions. If you know you will need extra cash flow over the next few years, work with a professional to execute systematic Roth conversions in years when your tax bracket is low. This gets money into a tax-free bucket so that future emergency family demands do not trigger tax penalties or Medicare surcharges. You cannot give what you do not have. Helping your family is a noble goal, but doing it blindly at the expense of your tax efficiency and retirement security is not love, it is financial recklessness. Take control of your money, use the tax code to protect your nest egg, and stand tall in your financial power.